two. Hello. Hello. Jeeve Galair, and a very warm welcome to you all to the Convention Centre in Dublin, to CFA Society Ireland's inaugural investment forum on the future of finance. And to all those who travel from overseas, we're very honoured to welcome you here tonight. I'm Noel Friel. I'm the President of CFA Society Ireland, and I'm hosting tonight's event. Our first investment forum is happening nearly 10 years to the day after the collapse of Lehman Brothers, and the beginning of what came to be known as the Great Recession, which had massive international ramifications for politics, economics, Europe, and the regulation of finance. Huge debt burdens shifted from the private sector to the public sector, which will have interesting consequences in the years to come, especially if or when rates rise. The post-World War II dominance of Western politics by the parties of centre ground has been shaken, not only by the direct economic effects of the crisis, but by a loss of faith in the capacity of the centre to manage economies effectively. Populist support is relatively strong today in an environment of relatively strong global growth. What will it be like when the next recession ultimately hits? The Great Recession that followed the financial crash of September 2008 also exposed underlying weaknesses in the structure of the European project, which suffered a double-dip recession over the past decade. Even today, growth and inflation levels remain low. Big problems still remain for Europe, for many countries, not least Italy. And who knows if the outcome to the Brexit referendum in 2016 would have been different if the Great Recession had not led to such a strong protest vote against the government at the time. The aggressive action of central banks and governments prevented the Great Recession from becoming the Great Depression too. The almost unprecedented experiments in money printing and dropping rates below 0% has appeared to have paid off. But policymakers must be careful that they don't cause a rerun of 1937, which was 8 years after the Great Depression, when the Fed tightened too soon, which caused a fragile US economy to weaken, and it brought in other economies with it. As we all know from studying our CFA books, it's the flow of money and credit that finances the spending on goods, services and financial assets. And after a long period of ample and rising liquidity, money and credit is now starting to roll over. This pullback is now the dominant force on financial markets, and in time will be the dominant force in economies as well. So where does this leave us today? It seems to me that we will see low returns for major asset classes going forward, a wide range of potential economic outcomes, example inflationary or deflationary, and tail risks due to the inability of central banks' monetary policy to act as a shock absorber in the next downturn. Well, many problems exist today, such as an ageing population, capitalism perhaps not working for the majority of people, high debt levels, Brexit, trade wars and climate change, to name but a few. There are many real opportunities out there too. One very real example is in the area of robotics and artificial intelligence. I recall a recent quote I heard from Warren Bennis. He said, "The factory of the future will have only two employees, a man and a dog. The man will be there to feed the dog, and the dog is there to keep the man from touching the computers." However, this assessment looks wrong. According to a report last week by the World Economic Forum, robots, artificial intelligence and algorithms could create more jobs than what they destroy. It's predicted that 133 million new jobs will be created over the next decade from these areas, compared to 75 million jobs that will be lost. And also the need to address climate change and advances in medicine will bring about many positive changes in our lives. Finance has a key role to play in these opportunities. In the words of Paul Smith, CFA CEO, finance has always created more economic advantage and multiplied opportunity across the spectrum. It narrowed the gap between the haves and the have-nots. It was a mechanism to see that everyone, whatever their original circumstance, got the chance. It never guaranteed outcomes, but it did provide openings. But it's clear to me today that we, as a profession, must build trust and integrity and instill confidence in the financial system and to help our clients achieve optimum financial outcomes and long-term security. And it's essential, in my view, that we put clients' interests first. Diversification, as we all know, is a core investment principle, but it is infrequently applied to the composition of teams at all levels of the investment profession. And not just gender, where fewer than 17% of senior leaders in investment banking are women, but other diversity dimensions such as ethnicity, culture, and work style. CFA is well equipped to be a change agent for diversity because diverse teams are better at meeting clients' needs. And our designation is truly accessible and attainable by all, wherever their background it is they come from. So we have a truly wonderful evening lined up for you tonight, guys. Commencing with a speech from Brian Corr, who's representing Minister Darcy, Minister of State, Department of Finance, who unfortunately can't be here tonight due to Dáil engagements. Brian is going to talk about IFS 2025 and how Ireland is trying to become a global financial centre of excellence and the success achieved to date. He'll also touch on Brexit. Next up then is Gary Baker, Director with CFA EMEA, who will present an overview of some of the main findings of CFA's Future Finance Initiative. He will then lead a panel discussion with a number of investment professionals. Lastly, we have economist, broadcaster and author David McWilliams. Then have some food and drink to allow an opportunity to chat to your fellow colleagues. There's no fire drill scheduled for tonight, so if you hear the alarm going off, run. And there's also, well, there were some free publications outside. I believe they're all gone, but if you want any of them, just let us know as well. So let me first introduce our first speaker, Brian Corr. Brian is a senior corporate finance specialist and head of credit union policy at the Department of Finance. He's an experienced financial executive with a diverse mix of corporate finance, equity market, and strategic planning experience across public and private companies and industries, and all at a senior level. His current role has involved managing a variety of strategic projects for the Irish government, arising from the recapitalisation and restructuring of the Irish banking system since 2011, including PTSB in 2015 and the sale of Irish Life to Great West in 2013. He also has a specific responsibility of credit union policy. He chairs a working group on the risks and opportunities of Brexit for the financial services sector and acts as an Irish expert to the Economic and Financial Committee Working Group on non-performing loans in Europe. Ladies and gentlemen, please welcome Brian Corr to stage.
Cheers, no. Thanks. Thanks very much. Good evening, and thanks, Noel, for the very kind intro. As you'll recognise, a lot of my experience isn't fully relevant to tonight, but there is some areas that I will touch on which are very relevant. I'd like to apologise on behalf of the Minister for not being here. He is in the in the Oireachtas on Dáil business tonight. I'm delighted to be here to talk, I suppose, about the future of finance rather than a lot of the work that Noel has mentioned on my CV, which relates to the time of crisis over the last 10 years. Of most relevance to your discussion tonight, I chair a working group with the Central Bank and the NTMA on contingency planning for Brexit in financial services. I'll share some of my thoughts on that topic, as well as IFS 2020, the government strategy for international financial services. One of the topics we've been asked to cover is how Ireland can encourage more investment management and financial firms to set up in Ireland. But it's worth putting this in context of the 30-year plus strategy for developing international firms' activities in Ireland and the success achieved in creating a robust ecosystem of over 42,000 directly employed people at this point in time. A predominant feature of the Irish market has been the success achieved in servicing of asset management and structured finance products. While there's no doubt that the bulk of employment stems from the administration and custody of the 4.4 trillion of assets, there's been notable successes in front office management activities. These include the leading position that Ireland has developed in aircraft leasing, where we've over 63% market share for leased assets. And through specific actions under IFS 2020, the government is looking to expand this to include new forms of aircraft finance and build on the deep pool of talent that's been developed in Ireland, as you all know. Similarly, in the area of alternative credit, a number of highly specialised firms manage portfolios of loans to large corporates and SMEs in Europe. Leading names in the international marketplace, such as Bain, KKR, Guggenheim and Blackstone, are engaged in this activity. And with the support of ISIF, new names such as Credit Value Partners have chosen Ireland as a base to grow their European business. I might just touch on Brexit, which it's likely to be transformative in terms of the financial sector activities that will be carried out in Ireland. Some of the notable success stories in recent years include new front office operations for Citi, for Credit Suisse and Citadel Securities. These have acted as important reference cases for IDA Ireland as it seeks to compete and capture and convert opportunities that have arisen from Brexit. The full extent and impact of the business that Ireland is winning as a result of Brexit will only become apparent in the future. But we can already point to the success of Barclays and Bank of America and Merrill Lynch in banking, plus the many investment firms that are choosing Ireland as their Brexit base, such as Legal & General and Aberdeen Standard. Over the summer months, 3 of the largest market infrastructure players in their respective markets announced that Ireland was to be their post-Brexit location of choice for the European business, namely Thomson Reuters, Equilend and DTCC. I started my work on Brexit on the 5th of November 2015. It was the first date I got involved. It's almost 3 years ago, and it's probably fair to say a lot has changed since. I'll just touch on a few emerging themes which might be of interest to you. Firstly, the progress of the negotiations since March has increased the pressure on firms to have contingency plans not just in place, but actually implemented. You'll see more hard evidence of this as the weeks go by. Secondly, the UK White Paper, which was issued in July, tempered the expectations of the UK financial services industry as the mutual recognition proposal that many had been seeking was dropped in favour of a more traditional third country relationship, though with some references to the potential expansion of the scope of the equivalence regime. Thirdly, many of the contingency plans for large firms, particularly the investment banks, involve multiple locations and in some cases multiple authorisations for different activities. Fourthly, the contingency plans for Irish regulated firms passporting into the UK have been reassessed to factor in the UK government's proposal for a temporary permissions regime and several other transitional elements they have proposed in legislation. Lastly, the financial services landscape in Ireland, and indeed in many other European cities, will be changed by Brexit. And while the EU will have a bigger financial sector, it will also be more fragmented than is currently the case. Ireland will be home to new firms and new activities, some activities never previously undertaken in Ireland. All of this creates a strong platform to build on into the future and an exciting backdrop for the development of successor strategy to IFS 2020. Initial engagements have occurred with the key stakeholders who constitute the membership of the IFS 2020 industry and public sector committees to find out what worked well in IFS 2020, what could be improved, and to identify emerging opportunities and challenges. A public consultation on the successor strategy will be launched very shortly. I'd now like to turn back to the current IFS 2020 strategy, which is, I suppose, updated every year, as you'll see in the annual action plans, and contains a suite of measures which are implemented both by private and public sector stakeholders. As the long-term vision for international financial services, the strategy was developed before the UK decision to leave the EU. However, it still provides a clear framework to maximise any opportunities and to respond to any challenges that might arise from that decision. The Minister has asked me to highlight two areas in particular this evening: fintech and sustainable finance. Fintech is now a horizontal sector affecting most areas of the international financial services industry, and I'll highlight just two initiatives. Firstly, the Central Bank has recently announced that they will launch an innovation hub and an industry engagement programme to keep pace with the evolving fintech and regulatory landscapes. Secondly, a colleague of mine in the Department of Finance established a working group on virtual currencies and distributed ledgers to explore how blockchain technology could improve, in many ways, government services. Ireland is well placed to capitalise on these opportunities and be at the forefront of the fintech sector in Europe for many years to come. On sustainable finance, Ireland's Strategic Investment Fund, the ISIF, estimates that Ireland's transition to a low-carbon economy will require over 40 billion of new capital investment by 2050, something which would be of interest to you as managers in investment management. Work is ongoing at an EU level to develop a classification system referred to as a taxonomy in order to determine whether an economic activity is environmentally sustainable. And the Department of Finance, through the IFS 2020 programme, has given Sustainable Nation Ireland a mandate. It's a platform for the promotion of Ireland as a world-leading hub for sustainable finance, business and innovation, accelerating that transition to a low-carbon economy. In November 2008, coming up shortly, Europe's Climate KIC, Knowledge and Innovation Community, in partnership with Sustainable Nation Ireland, will co-host an annual Climate Innovation Summit in Dublin. In addition to the IFS 2020 strategy, I'd also like to mention Capital Markets Union. Ireland has been very supportive of CMU and the development of deeper and more integrated capital markets in the EU. But this must also take into account the need to ensure that Europe remains open to outside capital and expertise. Minister Donoghue and his Lithuanian counterpart, Minister Sopoko, recently co-authored a paper on CMU, which was co-signed by the Nordic-Baltic finance ministers and supported the prioritisation of those parts of the CMU action plan with the largest impact and greatest support. Before I conclude, I'd like to mention the 4th Annual European Financial Forum, which is due to take place on the 13th of February 2019 in Dublin Castle. A number of high-profile speakers have been confirmed, including Raphael Bostic, who's President of the Federal Reserve Bank of Atlanta, and Anne Finucane, Vice Chair of Bank of America. We expect further announcements regarding speakers in the coming months. Thank you very much for your attention.
Thank you very much, Brian, for that. It's great to see all the success of IFS 2020 and the strong, ambitious targets for IFS 2025, indeed the work you're doing on Brexit too as well. And Brian was only told at 5 p.m. last night that he was doing that, so thanks very much, Brian. We wish you all the best in your endeavours, as your success is our success. Thank you, Brian. Next up is Gary Baker. As Managing Director of EMEA, he's responsible for the strategic direction of the EMEA region and strengthen relationships with member societies, universities, regulators and institutional partners. In his role, Gary aims to strengthen the voice of CFA on behalf of members to key stakeholders in the region. He is responsible for supporting CFA's policy development in EMEA, advancing the impact of advocacy efforts, and supporting EMEA member societies in delivering value to members and candidates. He additionally has management responsibility for the research function across CFA. Gary has been engaged in financial markets for the past 30 years. He previously worked at Merrill Lynch for 20 years, a number of global roles, including Managing Director and Chief European Equity Strategist. He holds a Master's degree in Geography from Cambridge University, and he earned a CFA Charter in 1997. Please welcome Gary Baker to the stage.
Thank you very much, and I'm really delighted to be here this evening, and what a fantastic turnout for a subject to which there is no answer. I can guarantee the future is going to happen, but that's about it as far as that slide is concerned. What I can promise for the next 10 minutes, I'm going to make some comments which really just sets a placeholder for the panel session that we're going to have afterwards, where we'll try and pick out some of the issues that I'm going to reference and perhaps talk about a little bit about, but I think it's much more important and useful for everyone that they hear from industry practitioners as to where they're seeing some of this debate and some of the challenges that we've faced, and more importantly, some of the opportunities. I think when we talk about the future, we generally talk about the downside of the future, and I think that's fundamentally wrong. I think in finance, we're still in a very privileged position as to what impact we can have on society, on how we grow, on jobs, on welfare. And I want to come back to that as a theme, because I think it's important that we grasp that opportunity in terms of how we control the narrative and how we get on the front foot. As much as the next 10 minutes will be Brexit-free, I think there are lots of other things to worry about. I think if you look at some of the policies announced in a recent Labour Party conference, there's a lot to think about there as to what the future state and what that relationship of finance to the economy might look like. That is all for the future. What I want to do at the moment is talk about some of the research that we do at CFA Institute. There's a lot that we do, massive amounts actually, in terms of content that supports what we do on the curriculum, on education, on continuing professional development. But we also have a very large area that really tries to look at thought leadership. And what it's trying to do there is really prepare the industry, our members, candidates, for what are the challenges and what are the opportunities that you're going to encounter. And so in particular, we have an initiative called the Future of Finance Initiative that is part of what I look after in research. And that, the clue is in the name. It looks 5 to 10 years out as to what are the challenges that we are facing as an industry, as an individual within that industry, and as firms of individuals within that industry. We've done 2 reports so far. We did a thing called Future State of the Investment Profession about 18 months ago. What I want to make some comments today about, though, is the investment firm of the future that came out earlier this year. And I really would encourage you to take a look at it. It comes in various sizes, 120 pages, 12 pages, 2 pages. Maybe start at the bottom and work out. But what it's trying to do, it's not there to predict the future. What it's there is to try and challenge you, both firms and individuals, industry, regulators, as to these are the issues that we think people have to talk about. These are the issues we think that people have to be prepared to embrace or challenge or work with or live with or adapt to. And that's very much the spirit in which it is written. It's not there as a manifesto. It's there as hopefully an aid memoir, an explanation of some of the trends that we're seeing and a way that you can try and engage. We're very, very keen that this is a form of engagement with the industry. And a large part of what we do is to take this report out into companies and really sit down and talk to them about what some of the repercussions or conclusions might look like. So, let's just level set to start with. Part of this work was based on a survey that we did of members back in February, March. About 2,500 people responded on a global basis, and we've got all shapes and sizes within the globe. 150 societies across 90-odd countries. So this really does, I think, give a pretty balanced view as to where the industry sees this on a global basis. Now, lots of the conclusions up front. I just want to give some easy data sets that none of this you're probably going to disagree with, but hopefully it resonates with some of your views and opinions. So, of that 2,500, 72% expect industry consolidation to accelerate, of course. 54% think that this fee pressure, squeeze on lower fee products is the biggest issue facing them within their firms, within the industry. 72% say impact of technology on decision-making will only grow. What I'm interested in is what that other 28% think. What's going to happen? Are they just going to sit there and carry on just writing and pen and paper? I don't know. And then 39% expect a decline in investment management professionals' jobs. Quite a low proportion, actually. Now, what that reflects is the fact a large part of our membership and candidate base is in Asia. In Asia, the majority of people don't think that there is a bleaker future or fewer jobs ahead. That overall proportion is dragged down by the views from Europe and particularly from the States or Americas generally. Asia thinks that investment professionals will grow as an industry, and that's understandable when you look at the middle class growth that we're talking about in those markets. Where are the opportunities? We talked a little bit earlier that Noel was talking about sustainable finance, and we were talking about what the minister was seeing in terms of some of the attributes or targets. And this link of finance to society and a greater purpose is something that we keep coming back to in a lot of the work that we do, whether on trust, whether on investor outcomes. And it's re-establishing or establishing that purpose of finance. Now, 55% of the respondents, CFA members, believe that they personally have a strong sense of purpose in terms of what they do. Ethics runs throughout a CFA charter holder's education. 20% of every level of the CFA is ethics in terms of questions. Here's the challenge, though. Only 28% this is true of their firm overall. So there's a disconnect between personal feeling of purpose and what you are seeing or what those people are seeing as where their firms are and what they're committed to. That's an unhappy outcome waiting to happen. 80% say investment solution mandates will grow, and we'll get into that much more within the panel session. This solution management, this solution outcome, is it just another buzzword within the industry? Does it really mean something more fundamental? And then 60% expect DC participants will be more engaged. another key element. How do you get investors to own outcomes and be engaged in discussion of outcomes? Does DC really help in that process? The way we try and sort of map this, it's a lot easier to think in big pictures. There's an awful lot of words that go along the next two slides, but this hopefully provides some kind of summary. This was from the first report, Future State Investment Profession. Now, as much as we talk about finance as sort of, issues specific to us, we're not. We're faced exactly the same issues, the big, big mega trends that every industry, no matter where you are, no matter what you're facing. So whether that's demographics, impact of technology, both on individuals but also on firms, and also on regulators, for example, on businesses, on governments, on their ability to monitor. What's the impact of that if we take that forward? Economic imbalances, we've talked about the repercussions post-financial crisis. Government footprint, a little bit of what I talked about. Can the government cope with this change? Who does it represent? Will people still regard the government as the legitimate way in which they can transact business and have that relationship with their country? And resource management, very much sustainability and that theme of resource management, stewardship. So these are the mega trends. There's lots of specifics that we talk about as far as finance things, whether that's models, particular ways of practice, or challenges. And from that, the initial report developed 4 scenarios. This, again, emphasized, this is not predicting the future. This is saying these are some of the things that might happen that you've got to think about. So fintech disruption, yawn. Yeah? It's, everyone talks about it. Every firm is a technology firm in some way, shape, or form. Every individual is a technology-empowered individual these days. But fintech disruption, long lead times, lots of consequences. Our annual conference for CFA is in London next year, a global conference. And the theme is disruption. That's it, simple as that, disruption. Parallel worlds. I mean, this is one that you could spend days talking about. It's really this hyper-customization, the fact that different people want different things. There's not single solutions to any of this anymore. Business models that rely on single solutions are defunct. Lower for longer, the reality of what the investment landscape is, perhaps, certainly when you're looking at maybe pension fund assets and longer-term liabilities. And then again, back to this sustainability, purposeful capitalism, massive amounts to unpick and unpack within that. But again, I'd direct you to some of the research. I'm just going to give a very high-level overview for you this evening. This is what the investment firm of the future summary looks like. And what it is, it's building on the previous report. So thinking about those 4 scenarios that I briefly outlined, but then trying to take that one step, one level down into what we call narratives, investment narratives. And really what that's trying to do is talk to specific sections of what firms are faced with. So business model, operating model, people, investment, and distribution model. Challenges for every business or every part of that business in each of those areas. And what we're then talking about is there's another level here. There are 30 narratives within those buckets that we talk about, which again is really challenging people to think about. What does technology mean to individuals? What is the operating model that is threatened by technology? Is that collaborative or is it replacing? Is it cyborg? Is it artificial intelligence? All the work that we do on, again, back to a trust study we did earlier in the summer, says that actually trust is improved by technology. But it's only improved by technology if it's attached to a human interface, not through a simple computer interface or a faceless interface, if you will. But that puts enormous pressure on people models. We talked about some of the prospects for jobs and the recruitment of investment professionals, but what sort of people are we talking about here? If you look at Jobs Outlook or jobs boards that we run internally, how much of that is skewed now towards quant, systematic, programmatic? There is always that angle to it, the ideal candidate, finance background, preferably CFA, program experience, welcome. So this, what we call now, we refer to these T-shaped people who have skills across a broad range. And this, I think, is one of the fundamental challenges that we spent a long, long time. I've been in the business maybe 30 years, and so much of that time was about specialization and getting better at individual, narrower focus. But now we're starting to see this demand for broader remits, broader perspective, broader outlooks, and which individuals have that. So is it teams of specialists or is it specialist teams? And it's a very different, subtle difference and change to perhaps some of the business models that we've been operating with. Sustainability and how that becomes embedded, you can't ignore that within a European context. What's interesting for CFA is that we operate on a global basis. So if I walk into our Washington office and we go and see the SEC, they hold up the fiduciary rule and they say, well, sustainability, okay, it's a factor, but ultimately it's about returns. And returns, I mean cash returns to your retirees, to your beneficiaries. So there are various stages of development or awareness or acceptance of where sustainability, ESG factors are. The EU is really very much in the vanguard of this, but I'd say it's very much backed and closely followed by what's happening in Asia. We do a lot of work in China on green finance. Australia, Canada, very much alongside European models in that regard. But there is no global solution here. It's going to be one of the great tests of how benchmarks, of how taxonomy is really developed as to how that goes across borders successfully. And then distribution model. I think underlying all of these things, there's an interest as to where value is going to move along that chain. Production, distribution, manufacturing, there has been a value shift. The industry, the financial industry, investment management industry, has been fantastically successful at retaining profitability within the chain. Yes, it's moved as to where those basis points are allocated, but if you look at the FCA report last year on overall profitability within the industry, it's been remarkably constant. And politicians would say excessive. And that's one of the biggest challenges. How do we show that our worth to society is greater than the rewards that we generate and take from it? That is one of the key challenges, I would say, that comes through, not just in this research, but in most things that we do. That's one of the elements that I encounter when I travel around Europe. Where is that value for money? If I talk to governments, talk to regulators, it's how successful we are as an industry in reinforcing that message that I think is really going to determine our health as an industry going forwards. And that's certainly what we are very focused on at CFA in trying to do. Bring in a greater emphasis on ethical decision-making, sustainability in a wider context, but it's that impact on the wider society that we will keep coming back to and reiterating. I am going to stop there. There's a ton of questions that arise from this, but as I said, I really want you to direct you to the research. I think it's in relatively good bite-sized chunks, but what's more important now is to get to the panel and we can start to sort of dive into some of these issues, and then there will be some chance and time for Q&A where maybe Brexit might come up. I've just got a clue, a hint or a guess it might do. But let's leave it there, and then I would invite the panel to step up onto the stage, please. Thank you. Yeah, I'll go down there. I'll take that one. Yeah. I was getting roasted in the lights. What I would ask for 30 seconds each is to introduce yourselves, because I can give name, rank, and serial number, but I think it's better if people get a flavor of where you are, and really, you know, that gives an element of areas of expertise as well. So let's start on my left, please.
Surely. My name is Patrick Burke. I'm with Irish Life Investment Managers. My background is mixed and varied, legal, consulting, and investment, I suppose. And lucky to have a very good team in Ireland.
Rupert Watson, Head of Asset Allocation at Mercer. Spend most of my time thinking about dynamic positions over underweighting equities, bonds, EM, those sorts of things, very high level background in asset management.
Vanetta Salali, and I work for GMO. I actually cover Irish clients, so possibly see some in the audience. As you can tell from my accent, I'm actually Australian, but I've lived in the UK for about 6 years now, so plenty of experience with DC and how it changes the market, so we can certainly talk about that later. My name actually is Samoan by background, for anyone that's interested. My dad is a rugby-obsessed Samoan, and I'm actually the only person in my family that doesn't play rugby, so sorry.
Well, I don't play rugby either. I'm Michael Kelly. I am the global head of multi-asset at PineBridge. And PineBridge is a $90 billion manager. Our predecessor firm, we actually were the team that ran AIG's $1 trillion balance sheet since 2010. Our majority owner is Richard Lees, the son of Li Ka-shing, the wealthiest man in Asia. But we're independent, and we have fixed income capabilities and equity and private equity, private credit, and multi-asset, and I built and lead the multi-asset team.
Thank you very much. So the format's going to be, I'm going to lob some really nice, gentle questions to the panel. And it will be directed at one of the panel members, but please, if people have different opinions, disagreements even better, then please do chime in. And then we will get to your questions, I promise. Maybe we'll start with Netta. It seems, I referenced a little bit about this shift from selling investment products to selling investment solutions. Mm-hmm. Is that really more than just a buzzword? And how are firms set up to really cope with that, in your view?
So I think it's more than just a buzzword. I think there are sort of some cost push and demand pull reasons as to why it's here to stay. I think from the sort of cost push side of things, everyone is looking at the value chain from consultants to asset managers to wealth managers and thinking about what part of that value chain they can capture and actually sort of retain margins in. So I think from that perspective, it's something that's here to stay for the industry. And I think from a demand pull side of things, there's plenty of clients, probably some in this audience, who would like us to do things on a more objective-based perspective rather than just going out and selling them a single product or a single fund. They want us to deeply understand what their issues are and try and solve for that problem. How is the investment management industry tackling it? I think there's lots of different ways that people are going about it. So I can tell you what GMO does. We have a big asset allocation business. We've sort of certainly set up our relationship management team to try and be solutions focused, so build long-term relationships, to think carefully about what the end client goals are. We're doing a lot of work on DC in the States, thinking about life cycle planning and how we can become better at that as an asset allocation team. But I will say that it's not easy, and I actually think there's probably lots of different types of expertise that you need in one single firm, and to say that you can be absolutely fantastic at all of those is a very big call. And so I think probably managers that are on the very large end of the scale can certainly offer everything. Do they have the best expertise? We can debate this. And then I think on the other end of the scale, there's very small niche managers who in some ways can offer one type of solution, but are they still relevant in this sort of ever more complex world? And like you said at the start, I don't think there's any clear, well, it's very hard to say exactly what the future will look like. So I think the investment management profession is very much trying to prepare for it without knowing exactly what shape it's going to take.
But maybe one just generally for the panel. I mean, in terms of this, do you get the sense that investment managers are prepared to commit to outcomes rather than concentration on risk budgets or benchmarks? Is that shift, you think, a real one? Is that possible? Is that doable within current business models? I know, Michael, you got...
Yeah. I think actually you were talking before about trying to justify what all of us do, and I think solutions is actually a very good story. Before we start flogging ourselves and saying it's so hard to beat the averages, true. It's really easy to dramatically underperform the averages. And solutions, if I were to use a US-centric example of this, the 80s and 90s were one of the best periods ever for investing. Throwing darts, 60-40 indexation, should have produced low teens returns over a 20-year period, amazing. At the end of that period, the Department of Labor ran a study on what the actual experience was for people in DC. And at the time, DC was a do-it-myself exercise. And the do-it-myselfers, unfortunately, bought, last year's hot fund, sold. There was no financial planning. There were no solutions. And the average person in the 80s and 90s, when they should have experienced 12% from throwing darts, actually experienced 4%. 4%. So solutions actually have already done a lot of great things. GMO, PineBridge, we're both practitioners of solutions. We have a big solutions business. We deliver an outcome, CPI plus 5 over 5 years. No benchmark, outcome. And, different markets warm up to outcomes at different times. It sounds like, wow, that's a better curtain. Let me go behind curtain A. But Australia warmed up to curtain A first, and it's coming around the world. But the inertia is sometimes very hard to break through. But for those of us who have persisted, we see the world of outcomes coming forward. I think it's a great thing for most, whether you're a very large asset owner being advised by Mercer, they're doing a much better job. What is the right solution for this type of product with their needs versus that type? Solutions have already done a great thing for big buckets of money and small individuals.
And of course, different end investors want different outcomes. Yeah. So a defined benefit scheme has very, very different objectives from a DC scheme. And I think DC investors, which is obviously a big part of the future, need to be, I don't mean told what to do, but need to have someone who understands what they want out of their product. Because investment is extremely tough. I mean, I don't understand how a light bulb works. And that doesn't mean that I'm a complete idiot. It's just that it's not my specialization. And so for people who are not financial experts, to understand the ramifications of buying different asset classes and whether you buy more, whether they go up or whether they go down, or whether you should be buying tech because it's exciting, but people say it's expensive. Most people can't possibly get those sorts of decisions right, and so needed to be guided.
I do think technology adds a huge amount to it.
Good, because I was going to ask you about that.
Providing solutions into large institutional client bases is is easier to do in the context of the type of conversation you're having, the counterparty to that conversation, the needs that party has are clear. When you are in the world, as Rupert speaks about, of defined contribution or retail investors, it's very, very hard to create a solution without understanding fully the needs of that investor. And the way that we can gather now the data analytics around customer behavior, what they're thinking, what nudges are appropriate for that point in time, I think that that's the key enabler of solutions, as opposed to the building blocks that we make in investment management.
And is the client clear on that? Are they embracing that? Or is this being pushed on them or introduced to them? Where's that balance?
I think it's on the turn. We would see in large DC schemes that the employer provides a level of access. But historically, employers have been the gatekeeper in some ways, and they've retained a paternalistic responsibility almost that they want to shrug. And the risk in shrugging that is that we close down the access points. So if you're an employer fighting for talent, you're high turnover of lots of young people coming in and out of various different countries in order to make it work, you actually probably can benefit hugely from technology, not just for a DC pension, but just to enable your employees to have a better work experience. And through that, you can then guide and nudge the ultimate investor, the end investor. And I would agree with Rupert. I think the amount of choice that we give to members can be quite dangerous. There's, I don't know light bulbs either, and there's one flashing over there the whole time. There must be something wrong with it. But, totally
let's switch focus a little bit. Passive active. Obviously, major, fairly tectonic shifts we've seen in some of that, but this idea that heralds the end of active or inevitable decline. Maybe Rupert, a view on that in terms of that remit, or as you see it from asset allocation, where is that passive active as far as you're concerned?
Well, I think there's a role for both, and the one thing that I think will be squeezed out are the sort of the closet trackers. Who go fairly close to an index, bit overweight this, bit overweight that, and charge for the pleasure. And so what the world is already moving in the direction of is a bit of passive for the sort of core beta, plus some sort of racier bits around the outside where it's possible to add value. But the sort of the closet tracker, I think, the closet access, closet tracker, but charging as though they're properly active is bad for the industry and bad for the reputation, because people are being paid for not adding a huge amount.
And Vanessa, on alternatives, and I mean, it seems to me at times we restrict our view on what a definition of active is. That yes, passive in public markets has grown, but the rise of private equity, alternatives, I mean, those are some of the most active asset classes available. Now, they're not always accessible to private clients in particular, but where do you see that role? Should some of the alternatives, private markets, be more accessible to public as well as institutional?
Yeah, ideally. I mean, I think something that we've sort of hinted at is this individualization of risk that's very much going to change our industry. So in the past, as a manager, I would have often dealt with large schemes, large institutions. But as DC comes to the fore, as private wealth comes to the fore, it really is going to be pushed down to the final end decision maker, to a person. And so if you are an alternative asset manager, if you're a private equity manager, you need to work out a way to get your strategies and that type of risk exposure to that end individual client. And I think if we can't do that as an industry, then we really are missing out on where their future is going. And I think the difficult part of that is that some of these alternative areas, I mean, for a lot of people, just understanding the stock market is incredibly difficult. So understanding how a private equity fund works, how a leverage loan deal gets put together, that is almost a bridge way too far. So I think as an industry, yes, we have to get these strategies much more democratized, but I also think we'll need to educate as we do that. And in some ways, that's probably going to be a much bigger hurdle than just actually getting the end product to those people.
And Michael, I mean, how far can multi-asset or should multi-asset go the world of? Is anything possible within that world? Should it be?
Don't ask a barber if you need a haircut. I'm a multi-asset. So at the end of the day, portfolios, for lots of good reasons, are diversifying. We all used to be about 80% home country stock market, bond market, real estate market. And now, really, people are investing in every asset class in the world. Who would have thought there was a private market for water and for the number of products? The number of markets is proliferating. It's like mapping the human genome. We're taking some asset classes and subdividing it into its underlying components. There's an explosion of betas. And we live in a world where the biggest problem in the world today is, like every other post-crisis environment we've ever been in, we end up with a global savings glut at the tail end. We have too much money chasing too little cash flows, and we have policy-distorted markets. And figuring out which of these many markets to be in has never been more important, because the expected return on most markets is much lower than most people expect, because we have too much money chasing too little money. So multi-asset, in our view, has a much more important role to play than in a world where you had three choices and you focused on security selection within those three choices.
But the too much money that's not a policy thing. That's the result of demographic changes, lack of confidence on behalf of households and businesses, and general savings profile. So I wouldn't blame governments for that. You can blame them for plenty of other stuff.
Well, if it sounded like I did, I think we have had very few financial crises in history, and in the wake of them, private sector deleveraging has nothing to do with governments. And people spend less aggressively out of their income, and they invest less aggressively out of their cash flow, and you end up with a naturally formed global savings glut. This is the first one ever that actually the central banks decided to rescue the world from the slowness that comes from that. And they created an unnatural liquidity glut on top of a naturally formed liquidity glut. So it's really, in a period, it's not a problem for the man or woman on the street that there's too much money. But it's a problem for all of us in living up to expectations. And I believe alpha, in being highly selective about beta, will be a big piece of that answer.
Okay, technology. Open question to you. What role does technology play in your current firm makeup, either internally or investment decision making or relationship with clients? And where do you see that going? I mean, how far can you push those models before you start to get resistance?
Well, in our firm, technology is critical. We operate in a multi-asset world, really using lots of different building blocks. We still believe that the solutions we're bringing to our clients, which are customized to those needs, will use the same, the customer will end up consuming the same amount of alpha, beta, and maybe now there's more gamma in it than they would have historically done in a model that would have been presented to them 20 years ago. But it will be in a different asset classes and different combinations of them. And that brings it more efficiently and gets greater access. But in order to do that, your dependence upon technology behind the scenes to implement the investment decisions is pretty critical. In terms of the leading edge pieces around AI and robotics, our progress in that space around the robotics is really just to make it more efficient so that talent can focus on what talent does best. rather than necessarily take that away from the talented individuals that are in the business. But the big enabler, I think, for investments, and you know, the CFA has touched on this, it's not what technology does for the investment decision-making process or the processes in delivering those to customers. It's what it can do for customers to enable customers to provide adequately for, whether it's their retirement or whether it's other needs that they may have. The technology that provides access to those customers and the way they will use it in 10 years' time is far more dramatic an influence on the investment industry, I believe, than it is in the front office or the back office.
I mean, investment's all about ultimately, you know, individuals investing via some channel in companies and bonds and whatever else it might be. And I'm not an expert in distribution, but I would imagine that, you know, that there will be massive changes, which will, generally speaking, drive costs down, which will ultimately be, you know, be good news for the end investor. From the perspective of those making the investment decisions, there will be more and more technology, including artificial intelligence, in the same way that quant managers now are pretty big, whereas 30 years ago they weren't, because the technology wasn't there. There will still, in many areas, at least I'm hoping, in my role, for the to be human at the end, who will make the investment decision. But the sort of question that might be asked, you know, I might ask to someone someone in my team saying, could you look into the relationship between the Citi Surprise Economic Index and subsequent currency returns? And so the chap who works with me on this sort of thing goes away, does the work, comes back and says there is a relationship or there isn't a relationship, and probably in 10 years' time, that will be automated. But
Siri.
Sorry?
Siri.
Yeah, exactly. Yeah, exactly. Yeah.
Okay.
But the end decision will still, you know, a lot of the end decisions will still need to be made by people. And the point you made, I think, on 130 million jobs, I don't think it means the technology means high unemployment or anything remotely like it. It's fabulous news, but it does mean certain jobs will go.
Beneath a long-term focus, right, within GMO, renowned for it, how do you get that balance as to that conversation? You know, there's this constant sort of debate within the industry that we're too narrow, we're too short-term. What is it that you can retain that interest and constantly reinforce? What's that message? Is that something we can do more broadly, that we should be, or what?
So first of all, I'd say that we've spent 41 years trying to get it right, and it's not easy. I think getting people to look at their behavioural biases and to think about how they affect their investment decision-making is incredibly difficult, even for people that have been doing it for years and years. So as a firm, you know, each time we sort of come into a bubble, we lose a lot of assets. Each time we come out of a bubble, we gain a lot of assets. And so obviously we need to just be patient as a firm, but you also need to have some pretty tough conversations with your end client. And I think you also have to try and, in some ways, be an investment counselor rather than just be an investor of their money. And I think, you know, as we talk about DC and getting people to make the end decision rather than maybe their company, that's actually a big part of the challenge, is getting people to understand times when they're going to get it wrong. So, I mean, at the moment, US equities have had an amazing run. I don't know what their PE is at the moment, probably 27 times. We have a big position in emerging market equities, which is sort of 11 times. So having that discussion about why an 11 times PE, sticking with that call versus buying something that's at a 26, 27 PE, that takes months. Literally, it can take months. And we don't always win people over. But I think if I was to give a lesson to the whole industry, it's that education first, investment second, really can get us a long way. And it's not very sexy. It's not particularly, always rewarding, but I think if you can do the education step first, you can actually leave people much better off in the long term.
Okay. Now, I'm going to ask a couple more questions, but I want people to start preparing for their big night on the mic in terms of asking questions out there. All is fair game on this. We may decide to ignore the question, but we'll certainly listen. But I'm going to continue with this for maybe a couple more questions and then throw it open to people. Okay, ESG, sustainability. As I said, I think there's strong regional differences or tendencies. Is it from the understanding or how you've encountered it within your decision making, additive, neutral, or negative in terms of where you see ESG factors versus performance? Anyone?
Happy to. Well, first of all, I think the most interesting new element in ESG is just think of where we started. 10 years ago, at least when I first heard of it, we had one camp claiming it added massive alpha and the other claiming it destroyed massive alpha. And it was really hard to get a good discussion going. I think there's been an awful lot of very good investment research since then, where most people now do agree, in studies that I would say are well done, that the governance element is associated with a modest alpha going forward. But many of those things in that modest alpha are things that people who actively manage already do naturally.
Yeah.
The E and the S have yet to prove themselves out as either creating or destroying alpha. At PineBridge, we actually, UNPRI signatory, our different teams do sign up to ESG. We do look at it as an economic risk factor, not in a normative right or wrong way. That who's to say the world won't change and all of a sudden begin punishing industries or companies that pollute or exploit child labor. Effectively, they haven't been for decades. In many countries, we don't allow that, and then that manufacturing moves to the emerging markets, and then we freely import it. But who's to say that won't creep up on us in the future? And so we want to know the economic risk and make sure we're fairly compensated for these things when we believe its day will come, and it will have much more of an impact on returns. But up to now, if you really look at the evidence, other than G, it's hard to see. But for many people, I think that leads to a natural conclusion. If it doesn't cost us anything, isn't a good thing to do. And it may save you a lot of money in the future.
Mm-hmm. Rupert, Patrick?
Yeah, I think that concluded it quite nicely. So I haven't seen evidence, and we have done substantial research in this area. We have not seen evidence of value destruction under the E or the S. And we've seen positive evidence of value accretion under the G. And we then ask ourselves, what's our responsibility? And what are our clients' expectations of us in how we deliver that responsibility? And it's certainly not to find a road which would destroy value. But it is far greater than to be apathetic to the issue. And I think you have a very interesting room here. So it's actually the views of those who are on the other side of the lights as to where you stand on this, because the vast majority of you are deploying capital. So in your decision making, I think it's pretty critical to know where your headspace is.
I'm going to sort of do what a politician might do and answer a slightly different question
Excellent.
to the one you asked, although perhaps they're related, is that the asset management industry is very, and appallingly perhaps, white heterosexual male. And that clearly doesn't reflect the world we live in. And it does mean that we as an industry are going to make errors if we don't reflect the world as it lives, as it exists. So just taking a practical example, building up to the financial crisis, there were lots of people some people were saying, well, there isn't a bubble, and some people were saying there is a bubble. But the reality is that, I mean, being frank, in my life and in the life of people whose research I read from the investment banks and the others, didn't know anyone who was poor and on a subprime mortgage. And so they just assumed, as I assumed, that banks and others wouldn't loan anyone with a slightly dodgy credit history any money. But if the industry had been more diverse and the people that we get information from, investment banks and others, just knew a bit more about what was actually going on in the world, then the bubble wouldn't have grown to the same extent that it did, and the crisis that happened thereafter, I don't think would have been so dire. And I think it's beholden on the industry to take a very proactive stance and not just pay lip service, and whether that means short lists that are 50-50 men, women, and whatever, go for it. We need to change over the next 10 years.
Yeah.
On that note, I'll open it up to questions. You have to wave quite vigorously because we can't really see. Yes. There must be questions out there. Here we go.
Hi, Garrett Hickey's my name, from a company called Noah. I'm a few steps removed from the investment side of things now at the moment. Just something that Vanita touched on as well, on the education side of things, so kind of educating people or the end clients so they can make better decisions on their behalf. I suppose as part of the future of finance, would anybody on the panel kind of see ourselves moving away from an annual kind of return structure whereby, we have clients' money working towards either an index benchmark or basically an annual return outcome to a more investment horizon based outcome, whether that's inflation hedge or other.
So we would do quite a bit of that at the moment in terms of particularly retail investors, where at the point of sale and throughout the course of that customer's experience, their return expectations over 1, 3, 5, 7-year horizons are set out, rather than necessarily looking for just a single annual return outcome. And it's the probability of loss, the probability of gain, and how associated or how closely associated that is with that individual customer's plan and their financial plan. So I think it comes back to advice. I have a slightly different view on education by different segments to Vanita, but I think, Vanita, you were speaking about institutional investors. And I think that there's a very big challenge to work education in the traditional model for the individual investor, and that's where the multitude will be. I think we need to use the technologies, the behaviors, and accept responsibility for getting that as good as it can be so that it can be an alternative to full education. And there's a responsibility attaching to that. And I don't think that that's a responsibility that we should be afraid of. It is a growing market, so.
I mean, I agree with President Trump, and I've never said that before, so I'm quite pleased to be able to say that. For company reporting, quarterly reporting, I think is very bad news and encourages short-termist behaviour. And I completely agree with Vanita that one needs to educate end investors that the one-year performance isn't the be-all and end-all, and that from my perspective, most robust investment processes have a much longer time horizon than that. On the other hand, that doesn't mean that we shouldn't be told what's going on on an annual basis. I mean, I don't, it'd be a complete cop-out for a fund management firm to say, we'll tell you how it's all going in 3 years' time, but just assume we're doing cash plus 3, and if we're not in 7 years, we'll tell you. I mean, I don't think that would work.
I mean, I think there's an interesting tension, though, isn't there? I mean, if you look at the world generally, there is such this move to real-time now ratings and information. If you look at TripAdvisor or something, one single review that's negative that happened yesterday can destroy, a period of trust that's been built up over a long, long time. So on the one hand, you've got a society that's pushing technology and real-time technology. On the other, we know or we feel instinctively that we've got to be pushing people to longer-term investment horizons. And I think that is a real tension as to how we try
and I'd say one thing, I don't work on our manager selection side, but when I know people who do, when we think about GMO, for example, GMO set out their philosophy and their process, and if after a year they told us that their funds had done really well because they'd been overweight the US and underweight emerging markets, even though they'd done well, that would be a serious alarm bell for us. Because that's not what they say what they say they do. But that again is back to the education piece.
I think we've talked a little bit about disruption, and I think when we think about disruption, what could really disrupt just investment management as a whole is something like Amazon Asset Management, right? Because they get the technology right, they already know the end client, so they can risk profile really well.
Exactly.
They have the trust. There's a lot of things that they do that we don't do. But I think at the end of the day, that trust that's built based on selling widgets can easily be destroyed if you sell a fund and the fund drops 20% in a year. We take that on as an industry and work very hard to try and educate clients around that. But I think that might actually be a barrier to entry for some of the technology providers. So I do wonder whether part of the solution for the tension is for us to partner more with some of these technology providers who have a different type of trust to us, and then work out how we can then somehow sell our funds that way without destroying the model completely. And
yeah, the trust point is fascinating. My children constantly tell me that they hope I get fired and that maybe I'd get a job at Apple. And
Something cool.
yeah, something cool. I tell them Mercer's quite cool, but it doesn't wash.
More questions, anyone? No question on Brexit or anything? Really? We have one here.
Well, you knew it was coming, I suppose, and I strongly suspect that this question was designed to bait Rupert, so forgive me, please. The Irish Prime Minister, certainly expects a Brexit deal within near reach through November. In part, I suppose, believing that, hey, there's going to be immense damage on a no-deal scenario. I'd like to hear the views of all the panelists, if I may, on the likelihood of getting a deal, but also what will happen on a no-deal Brexit and what will the implications be for our industry, both here in Ireland, obviously, given you're speaking in Ireland, but also in the UK.
Okay, can I take that one? So a lot in the press, and at least in the UK, British press, by the way, and British government, totally clueless. So if I want to understand what's going on, I spend more of my time reading the Irish newspapers. British press, dire. The question is not hard Brexit, soft Brexit at this point, because that will only be decided once we get into the future relationship, so that's 2020. The issue is whether there's a negotiated agreement or whether there isn't a negotiated agreement. A negotiated agreement leads to the transition, and then the discussion of hard or soft. And for the negotiated agreement, there are two things that need to happen. First is an agreement on the future relationship, which Theresa May has come out with a checkers plan that is rejected by the EU, is rejected by all opposition parties, most of the Conservative Party, and is madness. So that can't happen, but the future relationship agreement can be fudged. So words can be chosen and softened. The second thing that has to happen is the Northern Irish border, and that can't be fudged, and there needs to be something that's legally binding in the agreement. A border has to be somewhere. The only place it can either be is between Northern Ireland and Southern Ireland, no one wants that, or in the Irish Sea, which Theresa May and the DUP have rejected. Now, I think that what will eventually happen there is that there will just be some de-emphasizing, as Michael Barnier talks about, softening of language. Hard border in the Irish Sea sounds like a collapse, British sovereignty being destroyed. A technical check on whether a product is genetically modified or not is different. The person who sits opposite me is from Northern Ireland, and so I was chatting to him the other day, and he's a rugby fan. And from what I understand, that there is a United Ireland rugby team is neither here nor there and isn't considered an issue. But there are separate football teams. If someone proposed to unite for one Ireland football team, I imagine all hell would break loose. So the question is can the language be softened so that there is, quote unquote, a hard border in the Irish Sea, but isn't perceived as such? And I don't know the answer to that question. Your other question as to what happens in the event of hard Brexit, the so-called Brexiteers are of the view not a lot changes. What they fail to appreciate is that the EU is a legal construct, very important for the EU, so member states know whose responsibility is what, appropriately so. And the view from the Brexiteers is that the EU won't impose anything on the UK, failing to spot that they're not imposing anything, that there is one set of rules for countries that are EU, EEA, and then a different set of countries that aren't. My view under a hard Brexit with nothing to soften the blow is that there would be utter catastrophe, and the UK would suffer the largest fall of any country outside of wartime and possibly inside of wartime as well, and the economy would more or less shut down. That would lead to rapid political change on the UK side. The UK would then go back to the EU and say, dreadfully sorry, but we're out, so we couldn't go back in, and there wouldn't be time to do an Article 49, but that some accommodation would be made. Where the British government, I'm sorry I'm going on to my fellow speakers, what the British government is saying is that no deal of any sort wouldn't actually happen because it would lead to chaos, and therefore both sides would sit down and agree to a whole load of stuff on the grounds that from the EU side, of course they want British tourists going to Spain, going to Greece, etc., etc. Of course, Airbus wants the parts that are made somewhere in Wales. So the view from the UK side is that although agreement hasn't been reached under Article 50 on a whole load of stuff, it would be reached separate to Article 50, a whole load of deals that would keep the show on the road, despite the fact that's not really allowed under Article 218. But I think what the British government fails to realise is that A, the EU legally under Article 218 can't do it, but even if they could and they could fudge it, then it would give the subsequent negotiating power to the UK post-March 19, where the UK would say, if you give us what we want, you can get your 40 billion, but if you don't, we won't. And remember, from the EU side, the UK will have defaulted on 40 billion, which is quite a lot of cash. So my guess is what would happen, and the Irish government, I'm wondering what we might have a view, what would happen on the EU side, and Macron has hinted at it, is that the EU would want to have aeroplanes flying, would want to have British tourists going to Greece, and so would get together a list of everything that suits the EU, nothing that suits the UK, and present it to the UK as a take-it-or-leave-it package. So that package will include, we're happy to reach a temporary deal on aeroplanes. We're happy to reach a temporary deal on Airbus parts, because that matters to Airbus in France, and a host of things that keeps the EU fine, but we don't want to receive any British beef, because why would we? French farmers more than happy, Irish farmers more than happy not to get it. So that it would be entirely constructed from the perspective as what is good for the EU. And the British government would be hard pushed not to accept it, and then you get chaos on the UK side, but much less so on the EU side. Almost run out of
Wow.
May I say what he said? Plus, we've been quite pessimistic simply because if you look at the financial industry, I think they've been thinking the same as the politician. There'll be a last-minute Euro pass. And we're all woefully unprepared as a result. I think what's creating some optimism now, at least for us, is that sinking feeling in the room that, oh my God, this actually could happen. We better start crystallizing our plans. And that's a prerequisite for that last minute pass. It doesn't mean it's going to happen, but I think for the first time in a while, we feel the likelihood is beginning to climb from, way below even odds to below even odds.
The one point I'm just on the point on trade is that many in the UK side, and why I'm not quite as optimistic on that, is that, well, I don't mind. My local MP, who at the time was Theresa May's parliamentary private secretary, so 6 months after the referendum, I sent him an email saying the UK should seek to join EFTA, either as a temporary or permanent solution, and mentioned him the EFTA court, Article 112 and a few other bits and pieces. And on an official PPS, the Prime Minister, Downing Street email, he replied to me, "Many thanks for this, Rupert. There's some fascinating stuff in it, which I won't pretend I knew anything about." 6 months after the referendum. The British government are clueless when Theresa May says last week that being in the EEA, being like in EFTA, accessing the single market via the EEA treaty, she said it involves accepting all EU laws. That is not true. You accept only those relate to the single market, about 27%. She says recently it involves paying huge sums to Brussels. EFTA states Norway does not pay money to Brussels. And she sets a whole load of stuff that isn't true. So the British government is clueless. There are various people, like the so-called economists for free trade, although in their presentation the other day with Rees-Mogg and various others, Boris, it was more the economist for free trade because they could only find the one. But they have a lot of backing, and they believe in so-called WTO rules that is rubbish. The example that I give is that if I became bank manager of Barclays Portsmouth, where I don't live too far away, and my wife and children came in and said, "Rupert, many congratulations, you got this wonderful job. We'd all like to set up a bank account," I would reply, I need to see their passports and proof of their home address. And if my wife said, "We got married 16 years ago and you've been with the children from day one, why do you need those things?" I said, "Rules are rules. You need a passport."
No wonder they want you to work for Apple.
Anything else to add on that? Or are there any other questions? Yes, we have one question over there.
Hi, Sarah McCarthy from Bernstein. I'd just be interested to hear your...
Can you just have the microphone because it's tough to hear?
Hi, Sarah McCarthy from Bernstein. Just interested in your views on fee pressure in the industry and the kind of big move downwards we've seen alongside the move to passive, and what implications that has for the industry.
Patrick?
I think it's probably a trend. Yes, we're seeing a lot of it as an industry, and every publication will give you different analysis of it. But I think we're looking at it through the lens of specific mandates and more traditional ways of managing money. And I think if you come back to some of the points that Vineta was making and Michael, we would see the same thing. Customers are consuming and investors are consuming proportions of beta and alpha which are not different dramatically to the proportions of beta and alpha that they were consuming 20 years ago. They're just found elsewhere and in different ways, and they're manufactured by different shops, some of which are more efficient. So I think the way that we're structured as organizations doesn't allow us to respond to those pressures, and that's where we need to focus in more correctly. You will see a lot of, in our shop, probably, I'm going to guess, 70% of our systematic strategies are not sold independently as systematic strategies or beta strategies or that. They are part of an overall outcome-focused solution for our clients, and our clients will benefit from the value of the efficiency of some of those strategies and the return or risk management of some of the other strategies, and reward us accordingly. And that allows us to retain the talent and keep on investing in the technology. So yes, it is inherent, but if we are structured the right way, if we're understanding the customer's needs, it doesn't mean that the business can't continue to generate a return in itself. And if you look at the macro demographics, the key trends in the report, and align those up, there's an awful lot of what-if questions that you can ask about each of those things that are on the left-hand side. What if we align ourselves to that mega trend? How can we make the most of that growth and make the most of that opportunity? I think there's quite an optimistic outlook I would have for the industry, but I fully accept from year to year it gets harder to, without transforming your business, it gets harder to change your P&L.
I mean, a big bit of what we do is try to drive down prices from the fund management firms, and with quite some success, which doesn't always, enamor us with everyone. But our model is that we do the investment solutions bit, think exactly about what the client does, and then we farm out the end piece, the choice of stocks and bonds and whatever, to fund managers. And because we're buying in bulk, we can beat them down on price. So I think, I would say this, again, barbers and whatever, that us and people like us, I think will grow quite a lot over the next little while, because we can do the solutions bit, we can allocate to the sort of the best of breed, Vineta's point that not everybody can be an expert at all asset classes, and so we give some money to GMOs, some money to other companies who we think are the best at what they do, and at the same time drive down prices because we've got the buying power.
It's you have to put falling prices and margin pressure in context. So in our industry, effectively, if you have a certain number of accounts and you hold those accounts over time, and the markets go up 8%, you have an 8% price increase for doing the same thing. And I started hearing about margin pressure in the mid-'80s. I never really saw it until about 5 years ago. It's here now. But what we see in the industry is price for volume deals. The Mercers, the everybody's, frankly, are dealing with fewer asset managers, but they actually, for incremental volume, ask for much lower break points on price. So the asset management industry has lost some of its pricing power. But to be fair, its pricing power has been better than tobacco, if you want to think of it in that sense. Yep. And that's just the world we're in. Every industry is getting more competitive, and price for volume showed up 30 years late. But it's very rational. It's here to stay. And, you know, it's up for all of us to figure out more efficient ways to do things, and to be in that smaller group of firms that price for volume deals are awarded to.
Hunter?
Or you could, and to bring the two together, you could say that the asset management business is now the business of managing assets. It has changed, so it extends into the consulting element of asset allocation, into the consulting element of liability management, cash flow management, into the consulting element of individualization and how you deliver that. So to a certain extent, does asset management needs to actually, in the traditional word of what an asset manager is, does it need to shake off some of the boundaries that were set 20 years ago for its business model, in the same way that the consulting world has shaken off the shackles of some of the boundaries that existed for an independent consulting model 20 years ago. And really, I don't think that we operate in separate industries anymore. So the full value of the proposition still remains to the industry. And it's really the players that are sharing it out, and those who are successful will be the ones who can adapt their models to the earlier point.
I've got to wrap it up now. But before we go, could I ask each of you for one sentence on one piece of advice you would give to people in the room? One thing to think about, one thing to focus on. One sentence, though. Benita.
I think I would say disruption is coming, so be prepared.
Very similar. We live in distorted markets, policy-distorted markets. Disruption lies ahead in a massive way to business models. To us, the conclusion of that is high active share investing. And keep your powder liquid. A lot of this fee pressure is so that people can afford to go into privates. Privates is not some magical thing that simply because you invest in privates, you get a higher return. You get an illiquidity premium. Did you say one sentence?
One. There's a few commas here, I think.
I thought I was asked about Brexit. So That's all right. I loved your Brexit answer. No, you earn an illiquidity premium for doing things that no one else is willing to do, not for participating in a stampede. So the returns on privates actually going forward are plummeting as we speak. And for this reason, to afford the privilege of participating in that stampede, people are taking money out of every other active investment. So, you know, disruption means keep your powder liquid. Because if you're in private assets they're disrupted, you're going to zero. Yes.
One sentence.
Don't be emotional.
Don't be. How does one avoid that? We won't get into that now.
Okay. It's September 2018. By the end of Q2 2019, have considered and decide yourself what is your responsibility and what's your approach to ESG investing. But consider it and set yourself a time frame for considering and coming to a conclusion on it. Research it. That would be it.
Excellent. Can you please join me in thanking our panelists for a really good. Thank you very much.
Well, that was a very interesting panel discussion. Thank you very much to Gary from CFA, Patrick Marshlife, Rupert Watson from Mercer, Vanessa from GMO, and Michael Kelly from Pinebridge for the very interesting and intriguing viewpoints. So now, as time is moving on, and we want to move to the drinks and food in a tiny while, let me introduce a man who needs no introduction. Dave McWilliams is an economist, author, journalist, documentary maker, and broadcaster. He's adjunct professor of global economics at the School of Business, Trinity College, Dublin. He's ranked the 10th most influential economist in the world. He's devoted his entire professional life to the objective of making economics widely available and easily understandable to as many people as possible. He co-founded the world's only economics stroke stand-up comedy festival called Kilconomics. He also founded the Docu-Book Festival. In the money world, David advises Neil Woodford of the Woodford Funds, which is over 16 billion of assets under management. As well as writing a weekly economics column in the Irish Times, he's active on social media, and he is here tonight as well, I see, and was named Ireland's most influential Twitter user in 2016. David has written 4 bestsellers, and one of these, The Pope's Children, is the best-selling non-fiction book ever published in Ireland. Once upon a time, he had a few real jobs. He was an economist in the International Relations Department of the Irish Central Bank. He was chief economist at UBS, and he was head of emerging markets research at Banque Nationale de Paris. Ladies and gentlemen, please welcome Dave McWilliams.
Thank you very much, Noel. Obviously, my mother wrote that CV. She's very proud, you know, she's making it all up. No, it's a pleasure to be here. And I'd like to thank the panel for covering everything I was about to cover. So we're going to go on the hoof from now on. No, it was a very interesting panel. Very interesting. And I was intrigued that the words at the end were disruption, distortion, and not being emotional. So we will keep them as themes for our discussion or our chat today. Disruption, what it means. Are we at a tipping point? What that means. It's always very odd to stand up and talk about the world the day after the American president is laughed at by the United Nations. It tells you where we are. But the interesting thing is, and this is the interesting thing, when the world is at a tipping point, there is a weakness for all of us to think that this is new, that this is something that is different, that this is unique to our generation. It's unique to our world. The technology changing, politics changing, demography changing, geopolitics changing is somewhat unique, and consequently we are special. But actually, if you look at history, that's not the case. So, armed with that idea, I'll make the suggestion that if I was a normal economist, okay, you know what they're like? You put them in the zoo, you look at them, you feed them every now and then, and they get their forecasts wrong. You know those ones? Right, if I was one of those, I would come here with your charts and your fucking econometric stuff and all that malarkey, right? Okay? Armed with that stuff. Equations and stuff, right? Statistics. But I'm not one of those, so I'm going to come armed only today with a book of poetry. Okay? And this book is The Complete Works of W.B. Yeats. And the reason I come armed with poetry is because of the notion that nothing is new. You might remember from the Leaving Cert, which those of you who are not from Ireland, it is a bizarre ritual, a bit like the Mayans when they had these human sacrifices, but it's for teenagers. We put all our children through it, and at the far side, we've no idea as to why that is. But in the Leaving Cert, Yeats was excessive. And there was a book, or a poem called The Second Coming, you might remember. Okay? Now, Yeats wrote this poem 100 years ago this year, in Dublin, 1918. And he's sitting around the corner from the Merrion Hotel, by the way, which wasn't the Merrion Hotel then. And he's looking out at the world and he's trying to figure out what is going on. What is going on? What is likely to happen? What is likely to happen? And he writes these words, and The Second Coming, it's a beautiful poem. You might remember it. It's the one that starts with this turning and turning in the widening gyre. The falcon cannot hear the falconer. Things fall apart. The centre cannot hold. Mere anarchy is loosed on the world. A blood-dimmed tide is loosed. And everywhere the procession of innocence is drowned. The best lack all conviction, while the worst are full of passionate intensity. So think about those words. The centre sometimes doesn't hold. Why? Because the falcon, the dangerous thing, has got loose of the falconer, the thing or the person that should control it. Things sometimes just fall apart, but why? This is the interesting thing. He says, because the best people in society lack all conviction, allowing the worst people in society to be full of passionate intensity. And this, I think, is a really interesting way of describing the world. The repetitive nature of tipping points, the fact that this happened. And again, think about what Yeats was trying to do. He was trying to forecast what was likely to happen. He was forecasting the center cannot hold. He was saying the Austrian-Hungarian Empire is going to go. The Russian Empire is going to go. Not that we didn't think the Bolsheviks had happened, but the mainstream view was the Bolsheviks would be beaten. It was going to be a short-term thing. The White Russians would come through, and this kind of fuzzy, wishy-washy communism malarkey would disappear. The Ottoman Empire was going to go. The German Empire was going to go. Think about it. He wrote it before the end of the First World War, and it was only evident that Germany would lose at the very final weeks of the First World War. Now, what's really interesting is that, and of course, he was forecasting the end of British rule here. At the time, it's quite interesting that Britain ended up losing by 1921, when we went off on our escapade, on our tods, okay? First 70 years was kind of difficult, then it got easier, right? But Britain lost more of its landmass. The victorious Britain lost more of its landmass than the defeated Germans by 3 years after the First World War. Now, what really fascinates me is not all that this stuff happened, but that if you look and you read back at the civil servants, the military men, the economists, the journalists, the opinion makers, all the people of the time, none of them forecast the apocalypse that the poet forecast. Even the economists were saying, we're going to go back to the gold standard. It'll be grand. As we go back to the gold standard, it'll be hunky-dory, right? The people who were paid to forecast the future got everything wrong. Whereas the poet, the strange, iconoclastic, slightly sexually dubious, unusual creature, Mr. Yeats, got it right. So this has always struck me, was that why does the poet at a tipping point get things right? And the people who are paid to get things right, the economists, military, civil servants, higher echelons of the organs of state, get it wrong. Why? Now, I think it is because poets, musicians, artists give themselves the permission to think unconventionally at a tipping point, to entertain things that other people are not prepared to entertain, to talk about disruption and then take it on to a different level. So the unconventional brain is the type of brain that at tipping points where we're at now, we need to listen to. Unconventional people. But the question I have for yourselves is, do we actually, in our society, I'm talking about Ireland, but we can go out to Britain, we can go out to the United States, go to Germany, go to mainland Europe. Do we reward unconventional thinking? Or do we reward conventional thinking in our societies? Because it's societies that make the big mistakes, not just the companies. So think about it. Imagine you're back in school, right? Just imagine now, we mentioned the Leaving Cert, right? Imagine you're here in the September of the Leaving Cert year. Can you remember who you were sitting beside? I remember the total idiots that I was sitting beside, right? Okay, I can remember the classroom, I can remember the teachers, I can remember everything. I now know why I sometimes avoid school reunions as well, right? But think about the classroom. Did we in school, and do we still, reward unconventional thinkers, or do we reward conventional thinkers? I suggest that we reward in our system a particularly linear type of thinking. It's the kid who can absorb everything in their head in a little compartment here, somewhere here, I don't know where it is, and put it all in there, and then, amazingly, write it all down, like bejesus, in the middle of June, in a coherent, logical fashion. It's like rewarding a human filing cabinet, okay? Right? That is an intelligence. It is an intelligence, but it's not the only one. Because as you get older, and as you go out into the world, and as you work, and you meet people, and you make mistakes, you realize that there are hundreds of types of intelligence in the world, thousands of types of intelligence, incredibly creative people who don't do the conventional linear thing. They do the lateral thing, the unusual thing. But do we reward them? No, we don't. In actual fact, in school, we humiliate them. It's a little daily humiliation of the kid who says, I don't believe that. I don't think that way. Like, for example, I am very good mates with a fella who actually spent 5 years in school looking out the window. Just couldn't get it, right? Couldn't get it. In subsequent years, he has become an incredibly successful business person. He's a lovely family man. He's a great dad. He's a great husband. He's a really good all-round character. But in school, he and most of my class were punished because they hadn't got this conventional ability to absorb stuff and regurgitate it. Now, and you probably know this when you're around, how many incredibly clever people do you know now left school feeling quite stupid? Loads, I'm sure. But the corollary is also the case. How many actually quite stupid people do you know left school feeling very, very clever? Because they are rewarded. And those sort of people, if you imagine what happens, right? Every day the kids, the teachers tell them they're brilliant, and of course their mammy tells them they're brilliant, which is very important in Ireland. I was trying to explain to a New York audience what Irish mammies were like, and I had to explain to the New York audience that Irish mammies were the sort of mammies that made Jewish mammies look unambitious. Right? So you know what we're dealing with here, right? So these kids, think about these conventional kids, and they go to school, and they're told they're very clever, they go to Leaving Cert, I teach them in Trinity, they're very clever, they do well in college, and then they go into the big banks, and they go into the CFA, and they go into the insurance companies, and they go into the higher echelons of the civil servant, and they're all clever. And of course, their entire status as individuals is wrapped up in being right, because they've been told they're always right. And you know what happens when people whose status is wrapped up in being right? What they can't accept is being wrong, okay? But the rest of us know that you're only learning when you're wrong, because when you're right, you know the stuff. So you're not learning. But they go, and then they get up to the top, they go all the way up in a society like Ireland. And then something really weird happens. We call it confirmation bias in economics. Confirmation bias is we actually like hanging around with people who think like us, right? Who confirm our biases. No, you're intelligent. No, you're fucking great. Jesus, you're really great. Jesus, you're phenomenal. Fuck off, have a job, right? Okay? And we employ people who think like us. And then what do we get? We get groupthink at the top. And everyone thinks the same. So why did all the economists and most of the financial analysts in this country miss the small housing bubble that we had? Remember that one? Okay. Was it because the banks were greedy and mendacious? No, I don't think so. I just think they all thought the same. Nobody at the top thought any different. And as a consequence of that, when you have a system that only rewards a certain conventional type of intelligence, and those people tend to be rewarded all the way up, and you get confirmation biases in institutions, what you have is a recipe for large-scale failure. Not because anybody is out of line, but because everybody is in line. And that's what happened here. That's it. It's not particularly difficult, but it's systemic. And the reason this is important is because it continues to be evident at every juncture. Do you know Galbraith, the great Canadian economist, when talking about conventional people? I say he's Canadian because the Americans pretend he's American, because he's good. Okay? It's a bit like us when somebody wins the Booker Prize here. They're amazingly British. It's amazing. It just happens straight away. Rodney Doyle, the great British writer, right? But Galbraith said something really interesting. He said, when faced with the choice between changing his mind and finding the proof not to do so, the conventional man always gets busy looking for the proof. So keep that in the back of our heads when we talk about markets, and we talk about will it happen again, and we talk about where's the next fault line. It's not that these fault lines are uniquely evident to certain types and not to the rest. They happen because we tend to make mistakes all the time, and they will happen again. And if you want to read economics about financial markets, the best people to read are Minsky and Kindleberger, not least because they both have a framework as to what happens when credit is in the society. But the problem with conventional thinking is my crowd, economists. Because economists, by and large, are conventional thinkers. And they are terrified of breaking out of the tyranny of the peer group. Terrified. And if you think about what the economy is, right, what is the business cycle? You know, we all talk about business cycle. It sounds really interesting. But actually, what is it? What is it? The business cycle is nothing more than the aggregation of all the little decisions you make every single day at the kitchen table, driving around, hanging out with your missus, going for a drink. Should I buy? Should I not? Should I sell? Should I do this, that, and the other? When you aggregate up all those little decisions, that's the economy. That's it. It's not magic. So therefore, the fundamental basis for understanding the business cycle and where we are in the cycle, and are we here or are we there, you start by understanding us, humans, because we make the decision. And the business cycle is nothing more than human nature. That's all it is. So think about it. The business cycle is us making decisions. So we need to understand us. So then you think, well, how does economics regard humans? Like, I take the kids in Trinity, right? And they come in fourth year. And so they're traumatized. So we have to tell them to forget all the stuff they learned in the first 3 years and we start again. Why? Because when I asked them, I said, well, what do you know about economics? And they said, oh, well, the first thing we know, now we've done this for a couple of years now, that the man is rational. And I said, that's really interesting. Now tell me, well, what does that mean? And they say, then you know, when man is making investment decisions, he, and I mean it could be she, but he, just work with me here, right? He is cold, calculating, scientific, mathematical, logical. Assesses all the information in his brain in a cold way and then makes the decision. That's it, really. Have you ever met a human being like that? Would you go for a drink with someone like that? Okay, think about it, right? No. What are we? We're the opposite of rational. We're totally irrational. We're totally suggestive. We don't know our own minds at all. Why is that? Because that is the essence of human nature. The essence of human nature is, why do you think that when we got out of Africa, wherever we came from, Uganda, I think, or somewhere, Kenya, Uganda, over there, and we went for a walk about 100,000 years ago, and we said, look, we'll go for an old stroll and come out of the trees, hang out, right? Would you have bet on this creature? No, no way. I'd have bet on the lion, or the tiger, something decent that could actually, eat you, right? Not this kind of funny gangly thing with funny legs. No. But what's the difference between us and animals? Why did we become the top dog? Because we can talk. And when you can talk, you can create memories. You can create stories. You can create identities. You can create the mass movements of humans in various different directions. It's an unbelievably powerful thing. We're the only people who can talk. The only animals, who can talk, right? And therefore, talk is based on changing our minds, on being suggestible, on believing things. It's the basis of crazy things, memories, ideas, identities, like religion. What a mad idea. Totally ludicrous idea, right? But it's the basis of it, and we all galvanize around it. Advertising, it's all based on suggestibility. Why? Because humans are programmed to be suggestible. And we're also programmed to think that this time it's different. This is the other thing. Like, at my age now, I have friends of mine who are on their second marriage. I don't know what bit of the first marriage they didn't get, right? Fellas are 50-odd with a 29-year-old girlfriend. By and large, I don't think the 29-year-old girl fancies the 50-year-old bloke. As a general rule, I think this is called evolution. and Darwinism. But they say, oh, no, 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 this time it's going to be different. She loves me. It's like, fuck off. Right? Okay? But this is the way we are. Suggestible, and we believe in the future, and we believe it's going to be better. Now then put this into economics and markets and see what happens, right? Because then, of course, this leads to the idea, the other great idea that the kids tell me in Trinity, say, oh yeah, and the other thing we learned was, when the price goes up, the demand goes down. Sounds good, doesn't it? It's not true. Once you put human nature in on top of the price system, what happens in Dublin when the price of houses goes up? Does the price of the demand go up or down? It goes up because people panic. People panic. I mean, not so long ago I was on prime time. And I was talking to, there was a fellow, an economist from one of the banks opposite me, and Miriam was going, oh, David, genuinely, what's going on? It's all a very strange experience, and in my head these odd things are carrying on, but I have to suppress them, because I know there's 500,000 people watching them, including my mother. And but the fellow, the economist in the bank, and the other economists in the banks, have you noticed they've got really square heads? It's like talking to a television or something, right? It's like, meh, meh, meh. And he goes, oh, well, oh, don't worry, because obviously it's supply and demand, and obviously, you know, the price mechanism, well, so when the price goes up, the demand will go down. And Mary goes, oh, right, that's it. It's bullshit. What actually happens in this country is because we're suggestible and we all talk to each other, and we get giddy, and we panic, and the price goes up, and we bring forward demand. Because if we don't, we feel we're going to pay 50 grand extra next time out. So it works in the opposite way. Likewise, supply. The other way, everyone says, oh, when the price goes up, the supply will go up. Think about it. Think about, and the reason I'm talking to houses is because for you foreigners, don't worry, we're kind of obsessed, right? We're in a moment, just caught in a moment, as Bono would say. Anyway, the reason, what happens in the house, the Dublin or Irish supply of houses when prices go up? The actual stock of houses is the most important piece. So people like my mother, who's 83 next month and lives out in Dalkey in the house that we were brought up in, right? Okay? So the granny living in a reasonably decent 4-bedroom suburban house. She's not going anywhere. And she hangs around with, she's a retired school teacher, so if anybody else is the son of a retired school teacher, we can form a self-help group later on, okay? Because I feel your pain. But she hangs around with, well, she doesn't really hang around. You don't hang around when you're 83. But she goes for cups of tea with 5 other widowed, retired national school teachers. Like, imagine the scene, right? In the Killiney Castle of a Tuesday. And despite the fact that these ladies have a combined age of about 902, they're actually euphemistically called the girls, right? And the girls all live in the suburbs in these houses. And they always have, you know Irish families, they always have the son-in-law who was really stupid. You know, the good-looking fellow's stupid and decided to buy property in 2008. You know that fella? With the family heirloom. So he's in negative equity. Their daughter is trying to get the granny into a retirement home so they can sell the gaff and Dalkey to pay for your man's sins, right? So that's the dynamic. And the girls are always saying to me, you know, well, should we sell? And I'd say, well, I'm not sure. You know, it's up to you. They say, oh, but prices are going up, should we sell? And then the other one would say, sure, wouldn't you be mad to sell? The prices are going up, you should wait till next year, you'll make a killing. So what actually happens is supply sticks when prices go up. And demand goes up, and that creates bubbles. That's what happens. And as long as the central banks, my former employers, are injecting credit and facilitating this, you get the dynamic that is always in all sorts of economic variables for bubbles. That's it. And our system, our free market system, the beautiful thing about it is it's actually condemned as long as we have abundant credit. And as the gentleman was saying, with too much of the stuff going around, well, there was a very good expression, was it too much money chasing too little money? I like that. I'm going to use that, actually, my next column, right? You heard it here first. You can say total plagiarizing, but it's all right. Okay, it's a good one, right? But we're condemned. And then you superimpose human nature on it, and then you see, why do people buy assets? Largely because other people buy assets. I know you pretend that you do this really rigorous stuff, okay? I don't know, it's okay. We're amongst friends, right? Okay, but I know the deal. You buy it because we all. What basically happens to humans is we talk, and you get giddy together. Giddy. You follow the acid up. Giddy. Oh, shite. Depressed. That's what happens. So it's up to you as investment managers to figure out where we are in the cycle. You know, are we at the beginning? Are we at the end? Are we in the middle? Minsky has 4 or 5 stages. I won't go through with them, but they're pretty straightforward stuff, right? But it's all about human nature and how we are suggestible. You know? And I noticed this recently, why we do things. Where I have a friend of mine, the boom is back in Dublin. He's a friend of mine, and he owns, you know those huge 4x4s? You know the big black 4x4s? The ones you really need in Sandy Cove? You know them? Yeah? The Andean mudslides are shocking. People gone. Drowned in Scotsman's Bay from the mudslides if you weren't in the 4x4. So he's a bit of an idiot, obviously. But he's one of those car blokes. You know, there's basically 2 types of men, I believe, in the world. There's car men and non-car men. Now, the car bloke, he's nice. They're kind of weird. And I actually find men who buy car magazines a little bit creepy, actually. It's just something odd going on in their heads. But he's one of those lads. But I've known him a long time. And he asked me to go. He rang me about 5 weeks ago. He said, do you want to come and look at my car? Not really, mate. But anyway, I said, yeah, okay. And there's the big 4x4. And then eventually, I said to him, I said, okay, look, I said, what in the name of Jesus did you buy that yoke for? And he says, it's very simple, mate. If I'm in a crash, the other lad's dead. So what's going on in his head is he's buying on the basis of what other people do. And I really feel that we should understand this, because this captures markets. And I really learned this first when I was in my first real job, because I was an economist in the central bank, but that's not a real job, you know. It's only a Mickey Mouse job, right? I was working at UBS. You get good degrees and all that sort of stuff, but it's really, you know, sitting around reading the paper most of the time. Then the place crashes. Oh, me? Oh, Jesus. Me? No, I was watching the GA at that time, you know. I was actually, but anyway, I got a job at UBS, and it was back then when financial markets were really interesting. Remember, you have a big trading floor, huge trading floor, you know, none of this algorithm nonsense, real people, right? And of course, the UBS basically was a Swiss bank that bought an outfit called Phillips and Drew, which was a UK outfit, and the whole trading floor was full of Cockneys, all Cockneys, right? Now, I have a thing for Cockneys. I love Cockneys. They're kind of God's chosen race. You know, I love the way they can't walk by something without robbing it. You know, they've got thievery inside them. It's great. They're lovely people. And of course, you know, you arrive and you're really nervous because you've never had a proper job before. And of course, didn't realize the job of the economist in the market is to talk. And of course, the job of the economist in the central bank is to stay quiet, right? So it's like, and then when you notice the people who get to the top of the central bank are the people who've never said anything in 40 years. They say, how the fuck did he get here? Jeez, I never saw him before, right? But he's there, right? That's happened to the Irish civil service. That's how it happened. So I remember getting up, and you know, you'd arrive in, and they're all Cockneys, and you're thinking, oh, geez, what am I going to do? And you arrive up, and there's a big trading floor of Cockneys, and there's me, and I'm about 27, but I look about 15, and I look as if I had a rosette on my suit. I'd be just out of the communion, right? And I get up, and I start to talk. And you're if you've ever been on one of these massive trading floors, like your voice comes out over a tannoy, and you don't know how Irish you sound until you're in England. It's really terrifying. And you're thinking, and your voice is up here like, and of course the job of the economist is to get the Cockney traders on your side, because if they're on your side, you're gone. And of course the guy said to me, I was going, and the dollar, and then the Deutschmark, and then yen, and all I heard the Cockney going, fucking hell, he's Irish. Because they didn't expect us in a suit back then, you know. This is the early 90s. And you know, I expected, as we all do, to get the name Mick or Paddy, but I didn't get the name Mick or Paddy. On the very first day in UBS, I got the nickname of Semtex. Now, can you imagine the chief European economist of UBS being introduced? He's all right, Semtex, yeah, he's bloke, yeah, he's all right, fucking Irish kid. Right, so, but I want to get back to human nature. Because all the Cockneys, and the great thing about the Cockneys is their parents are really unimaginative. They're all called Steve. don't know if you've noticed that, though. Big Steve, Little Steve. And Big Steve was a big kind of bull cockney, and he was on the desk. And I was terrified of him. And I had to sit beside him, which was really terrifying. I didn't realize actually what a coke habit looked like until I met Big Steve. It's always it's amazing about cocaine. It's the fatter the bloke, the bigger the habit. I thought it was the other way around, but no, it's very strange. And Big Steve, I remember we went home for Christmas, and Big Steve, and of course the Cockneys love a bit of flashy stuff. They're like Italians that way, right? And we went home for Christmas with our bonus, and I came back about the 5th of January, and Big Steve is sitting there, and he's got this really weird sort of effeminate wrist movement going on. And he would not now, I wouldn't put him down with Panty Bliss, at the front of the gay pride now. He wouldn't be that sort of fella at all. He'd be more heterosexual, right? So I couldn't, and of course what he was trying to attract my attention was the watch that he'd bought with his bonus. You know those watches that are so fancy, they have 6 little watches in them? Like you wouldn't know if it's going to tell the time or call in an airstrike or something, right? And so I look at your man, and eventually I said, "Oh, Steve, lovely watch." He goes, "Yeah, it's lovely, isn't it, Semtex?" I said, "Jesus, it's fantastic." And of course, the question he wanted to ask me was how much did it cost. So I said, eventually, out for about an hour, killing him. And I said, "How much did it cost?" And he goes, "It cost me 15,000 quid." I said, "Fucking hell. What does a watch do for 15 grand?" And he looked at me, big lad, and he goes, "Well, Semtex, it tells the time at 800 feet below sea level." Think about it. This is a fat lad who'd never been out of the shallow end, right? But somebody had got inside his little stupid head and told him his coke dealer wouldn't rip him off, or he'd have more sex with fellas or girls, or whatever made him feel good, or he'd be a better trader if he bought the watch. Why? Because people are suggestible. And as long as you understand that, you understand the business cycle. The business cycle is simply us. And we are now in the giddy phase, okay? We're not in the depressed phase yet. And the question then is, America's in the giddy phase. I'm talking about the English-speaking world, okay? We're all in the giddy phase. And the question I have for you is then, do big issues like Brexit disrupt the giddy phase? Because the giddy phase eventually peters out, okay? But do things like Trump or Brexit bring the giddy phase to a premature stop? That's really it. And I don't think so. I think we got an extremely informed lowdown on Brexit from Rupert, so I'm not going to go there. It's very important that you listen to proper experts on Brexit, right? But I think Brexit is the culmination of a process in our closest neighbour which is quite worrying. And the reason I say this is this week is the anniversary of the Bruges speech. You might remember, I was at the Bruges speech. And the reason I was at it, I was a postgraduate student in a place called the College of Europe. And the College of Europe is like kind of a finishing school for the European Union, right? You go to the College of Europe and you work at a central bank or European Commission, the ECB, all that sort of malarkey, right? And Mrs. Thatcher opened it. So I remember shuffling along, and it was September of 1988. For those of us old enough in the room can remember that in 1988, relations between Ireland and Britain were rather fraught, okay, to say the least. There was IRA bombings, there was all sorts of things going on. And Mrs. Thatcher was speaking. And I remember she came into the room, and she was really impressive, even then. So the room wasn't that much bigger than this. It was like the town hall in Bruges, but it was quite small. And the first thing she said wasn't this discussion of Europe, but she started to thank the local cops, the local firemen, and the local Coast Guard, because a British ship had sunk in a place called Zeebrugge, which is only 2 or 3 miles from Bruges, the week before. It was something really terrifying, like one of the big ships that leave here. It was a ship that had just keeled over in the harbour at Zeebrugge, and I think 200 or 300 people were killed. And she started her speech by talking to the representative of the cops and the Coast Guard and thanking the Belgian Navy and all that sort of stuff. And then she went into the Bruges speech. What was very interesting about the Bruges speech is it wasn't radical at all. Compared to the stuff you hear out of Rees-Mogg, Thatcher was just saying, look, federalism, we're not that into it. Calm down, be all right. But there was never talk about leaving here or leaving that. But what really struck me about the Bruges speech was the name of the ship. The ship was called the Herald of Free Enterprise. The herald of free enterprise was exactly what Britain was then. It was a country that understood free enterprise, free trade. It was not nativist, it was global, and it was constantly looking for opportunities, free enterprise. Now, what intrigues me about Brexit is how Britain has gone from the herald of free enterprise in 1988 to Boris Johnson's rather colourful description of business last July when he was overheard to say in Brussels, and then didn't deny it, "What about business, Boris?" And he said, "Fuck business." So this is an important point. How does a society, our closest neighbour, how did the Tory party go from the herald of free enterprise to fuck business? Okay? That is a big change. I believe that Brexit is a golden opportunity for us. It's a golden opportunity for Ireland. And the reason I think, by the way, I think in the next few weeks, it's going to end up like, do you remember that thing Y2K? Do you remember Y2K? Oh my God, planes are going to fall out of the sky. And your computer is going to blow up in front of you, right? Unless you pay PwC 800 quid. Do you remember that? I've noticed that PwC are back in the Brexit shit as well, right? But you're Mr. McQueen, you should like to come to a Brexit breakfast? No, fuck off, right? Think Y2K. There is an industry, I'm not saying it's wrong, but there is an industry that has built up in the last 2 years which is based on apocalypse. I'm not too sure that's what's going to happen. I think it is more likely that we'll get the fudge. And we will give a fudge on Northern Ireland. Not least because that would seem to be what most people, bar the jihadis on either side, want. Okay? The Brexit jihadis are kind of upper class jihadis. It's kind of Eton jihadis, right? Okay? Looking forward though, if our closest neighbour, if the Conservative Party of our closest neighbour end up being run by somebody or a cabal for whom business is secondary, or they vote in the members of the Socialist Workers' Party, Corbyn and his fellas, right? Okay? This is an opportunity for Ireland that we should grasp. And rather than spend our time freaking out about something we can't actually change, which is the vote of the British people, we as a pro-business country should be saying, Grant, they've gone a bit mad, right? But we're not mad, last time I checked. In actual fact, I think our government should be giving tax break to British companies that can prove they left because of Brexit. Come here, right? If you can prove that you left because of Brexit, come on in, okay? But my point is, it is an opportunity for us to become like Shanghai was to the Chinese in the period from 1880 to 1948. It is an opportunity to become a Hanseatic trading nation. That's what we are, okay? And I wouldn't worry that much about it because it is the culmination of a process in our closest neighbour that has manifestly changed its political, social, and I think economic DNA. Who knows? I mean, about the constitutional stuff, I'm not sure. Scotland could already be independent for all I know. Should nobody understand them? They could already be gone. They could already be using the euro up there. Nobody knows, right? Okay? But the point is, it is an opportunity for us if we see it as an opportunity. I think Trump is also an opportunity for us because Trump, because of this sort of endemic craziness, has suggested that the United States is not the safest place in the world for anything, including capital. And remember, we only have to get a tiny morsel of this business. Tiny morsel, okay? I also think that for the European Union, Brexit has profoundly strengthened the European Union. But all we have to do is make sure that we use the veto if Macron decides to change or agitates for the change in corporation tax. And we should argue we're all for harmonization, but we should harmonize down rather than harmonize up. And that's the way we should play it. Because we're stuck at a moment that you can decide is an existential threat, or you can actually decide is an enormous opportunity. And I think there's much more in it for an enormous opportunity, but unfortunately the government and a lot of the people who run the place are going to the threat side. So, to conclude, if we look at the economic cycle, it's nothing more than us, okay? It seems to me that there is a little more way of this to run in the United States, although the combination of excessively easy fiscal policy and monetary policy at the end of an 11 or 10-year boom, or at least expansion, would, if I was in your business, which I'm not, I would worry a little bit about the policy consequences of that. We already see the policy consequences with the very strong dollar at this stage. I do a lot of work in South Africa. I'm obviously going to do less work in South Africa because we can see what happens to the rand, what's happening to the lira in Turkey. But emerging markets, unfortunately, have to play second fiddle in this business. And they always will. When credit is abundant, they get lots of credit, it's all fine. And when credit becomes slightly less abundant, they tend to get starved. It's a bit like the Serengeti, you know? When water comes into the Serengeti in the rainy season, and everything is verdant, and then very quickly the water comes back and everything's parched. That's the unfortunate position of emerging markets. But if to come back to us in Ireland, okay? It's really interesting what has happened here. In the last 30 years, actually in the last 40 years, but if you take the time between when the Pope first arrived here in 1979, okay, and the last fella a couple of weeks ago, right? Something amazing has happened here. This country has grown twice as fast as every single other developed economy in the world. There is no European country, nor on the American landmass, that has grown as quickly. We're talking a couple of Asian countries led by China. Okay? Something phenomenal has happened in this country. And we spend all our time fighting about the problems of success when we should look at what has happened here. This country last week was number 4 on the Human Development Index of the United Nations. Do you know where we were when the first Pope came? 28. This is a phenomenal improvement. Why? Because we're open to business. We do more or less sensible things. We screwed up last time, okay? But the very interesting thing is the economy has rebounded very quickly. There is something going on here, and it's called being open to trade and ideas and people. And as long as we stick to that, there are enormous upsides for everything that's going on around us. But, and this is why I'm going to end with yourselves, do you remember what Yeats was saying? Things do fall apart if you let them. Why? Because the best people lack all conviction, and the worst people become full of passionate intensity and dominate the discourse. And I say this to you as somebody who's spent a lot of time in the same industry. You are the best people to talk about finance, to change the debate, to speak to people who think we should lurch to the extremes, following the Brits and nationalism, for example, with Sinn Féin, are going down a sort of a hyper-left side with other people, okay? Be more vocal in the debate. Be more vocal in the society. I really feel that. Because if you come in and write editorials and op-eds, you change behavior. You change what people think. And what you do is you keep the center ground, which is basically what has kept us wealthy. You keep the center ground invigorated. So looking forward, I'd ask you to think a little less like investment analysts and a little more like poets, particularly vocal ones. Thank you very much. Thank you.
Thank you very much, David. A very fascinating insight into man, human nature through history, politics, poetry, stories, and economics. Well done. So that concludes our first ever investment forum, and many thanks to all you guys for attending. And a very special thanks to Niall MacDonald, who alongside Martina Walsh and Claire Paul spent many, many hours planning tonight's event. Well done, guys. And of course, many thanks to our excellent speakers and panellists, to Brian, to Gary, Vanessa, Rupert, Michael, Patrick and David. You're a credit to yourselves, your families, your firms and the investment profession. So that's it for tonight. Please join us for some food and drinks outside, an opportunity to network with people you know and people you don't know. Thanks very much, guys. Thank you.